Everyone, this is Jordan. This video is being recorded on the afternoon of Tuesday, August 22nd, 2023. Thank you so much for tuning in today. In this video, I'm going to talk about essentially a lot of major breakouts happened after 13 years, after 13-year corrections or bullish consolidations. And before I get into that, it's important to note that this analysis is subjective. So I don't want to say it's entirely for entertainment purposes, but when we're making important decisions in tracking the important research and evaluating things, it has to be from things that are objective or objective data. Examples of things that are not objective are, Elliott wave counts, majority of cycles analysis. I mean, those types of things are subjective, and that's more for, I don't want to say it's entirely for entertainment purposes, but it's important to focus on the hard data and things that are objective. And so this video is subjective. I'm just making that clear that this is subjective. So it's a little bit for entertainment purposes, but nevertheless, it is interesting how a lot of major breakouts have occurred in 13 years in markets over the last 100 years. So I'm going to run through those and then talk about gold at the end. So first things first, the stock market. Interestingly, the three major breakouts that have happened in the S&P 500 were all 13 years. They were after 13 years of bullish consolidation. I've talked about this one before. I mean, you had a bullish cup and handle pattern. This move here, I mean, a lot of people in real terms say the bull market started here. I think the secular bull started here just because it made such a huge move, even though in real terms, it really started here. I mean, it made a huge move here, and then it didn't give much of it back. So this kicked off, 49 to 57. I've said it before. This was one of the strongest moves in the history of markets. Only a 20% decline here. So, and then I'll go to this one right here. I mean, 2000, this was 2013, so another 13-year breakout. I'm getting a little bit liberal here with this example. I mean, we had a peak at the very end of 68. I mean, this broke out here at the end of 80 into 81. So I'm fudging it a little bit. If I round, so this was, I think, November, December 68. If we just bump it up by a couple months and say 69, this move was in 82. But so I'm fudging it a little bit, but I mean, more or less, this fits the pattern of a 13-year breakout. Now, here are some other examples that are not as obvious, not as well known. I've talked about this in a few other videos. Shout out to New Low Observer. He has great historical charts. So this is the gold price traded in Paris. And we know that the gold price was fixed until 70.71. We know that the gold stocks made a huge breakout in 1964. But looking at the gold price in Paris, remember, commodity prices peaked in 1951. You had a 33 to 51 move in commodity prices during the Great Depression. Inflation peaked in 51. Then it went down for another 14 years. In the mid-60s, inflation started to tick up. So, I mean, this chart right here, this was a 13-year breakout. So and I've said it before, I'll say it again, if the gold price was freely traded, you would have seen a peak here, and you would have seen a breakout in the mid-60s when inflation really started to move. So this is another example of a breakout after 13 years. Here's another example, not as clean as the other ones, but this is spot commodity prices. It's really hard to get data on spot commodity prices, even though I think the spot commodity price basket is way more instructive than the CRB, which is, if I want to do a Trump here, I'd say the CRB is like 98% oil and nothing else. But you guys know what I mean. The CRB is just the weightings are just really out of whack. And so spot commodity prices, to me, it gives a better picture of commodity prices. And, spot or equal weighted baskets, they show you that the peak was in 2011, went a little bit above the 2008 peak. So for me, I really say that commodity prices peaked in, this looks like it peaked in 2010 actually. But I mean, for me, I really say that commodity prices peaked in 2011 and not 2008. But nevertheless, I mean, this is from Bloomberg, so this is somewhat official. You had the peak in 2008, and also, why we can say this was a third. So this was at the end of 21. It made this move, and this is from, I think, this chart is from Feb 22, I think. So it went up more here, and now we've probably come down to around here, kind of probably around that previous resistance. But anyway, it's for me, you can say that the base began in 2008 because it only went above this peak here only went above 08 very briefly. I mean, it would be a different thing if it went up like this and then it had a major pullback and then went up again. I mean, I think then you would have to say the peak was here. But I think you can say the peak was really here because what happened in this index, commodity prices went up like that and then they immediately went down, and that was it for a decade plus. So that's why 2008, 2021. So this is another example of a 13-year breakout. That brings us to the here and now in gold. So, I mean, this was, I think the peak in 2011 was, I want to say August. I mean, if you're looking at an hourly or daily chart, there might be a mini double top there, August, September. But nevertheless, August 2011, and we're in August 2023. So it's been 12 years. So who knows? Again, this is subjective, but 13 years, maybe next year is going to be the year that the gold price will break out. It'll be a 13-year breakout and follow all these historical breakouts after 13 years. Now, why could that happen? And again, this is, the problem I have with a lot of technical analysis and chartists is, like Gary Tanashian says, it's charts only. They don't think about other things that impact the market. And the gold market is so crazy the way it moves. Like, it's really difficult to analyze it only with charts. And so for me, I'm thinking about the fundamentals, and not to trail off here into another video, but you have a strong potential for a recession next year. And because of that, you have potential for rate cuts. And who knows what's going to happen with the bond market if yields keep rising. That could cause some kind of a shock. So I think the odds are reasonably high that you're going to see a breakout in the next 12 to 15 or 18 months, to give myself a lot of time in the gold market. And who knows if the long-term bond yields keep rising for the next month, I mean, that could cause a shock quickly, and where the Fed might have to immediately cut rate. I'm not predicting that. I'm just saying, that is in the realm of possibility. But nevertheless, there's a lot of fundamental reasons why we think that gold could break out next year and fit the 13-year pattern that we're seeing in all these other markets. So, I mean, this is subjective. It's not objective. You don't want to base everything on this, but I'm just pointing out here that, with that clickbaity title, that the 13 years next year for gold, it's lining up with history. We'll see if it happens or not. If it doesn't happen, don't worry, I'm not going to delete the video. Thank you so much for tuning in. Let me know your thoughts, and I'll see you guys again in the next video.